Welcome to another Market Matters webcast. I'm Nicholas Forsyth, Director at Market Matters, and I'm joined by James Gerrish, Chief Market Strategist at Market Matters. James, welcome.
Morning, Nick.
Morning, James. So what we're going to do now is we're going to talk about, for investors out there, what has really changed in 2016 and what investors should be mindful of leading into the new year. Now, I guess a lot has changed this year, James, like a hell of a lot. Now, I guess interest rates is a key theme, with the hike we've seen recently, from the US Fed. Just wanted you to help the investors out there, step them through, what this means for their portfolio and what they should be mindful of leading into the new year.
Yeah, massive year in 2016, as you made mention of, some of these big trend changes that we've seen. So, interest rates are clearly one of them. I think the best way to, highlight that is looking at what's happening in the US. The US 10-year bond yield has gone up from about 1.3% to about 2.6%. So even though we've seen only one rate increase in the US in the last 12 months, bond markets are pricing in higher rates into the future. So the Federal Reserve is now guided to 3 interest rate hikes in 2017. The market was positioned for 2 interest rate hikes in 2017. So, what that means from a portfolio perspective, interest rates are going up. So it impacts different stocks, different sectors of the market differently. And banks, for instance, we've got a reasonable holding in the banks at the moment. Higher interest rates are supportive of bank earnings. So if interest rates locally go up by 1%, so a 1% rise in interest rates here in Australia, that'll mean about a 2 to 3% EPS, earnings per share uplift for Aussie banks. It's about a 5 to 6% earnings uplift for regional banks. So that's obviously a positive.
What does that mean for investors out there for their dividends? A lot of investors on the phone love their dividends. It's a word I hear a lot on the phones. I just buy banks purely for the dividends. Now, higher interest rate environment, what does that mean for investors with dividends? Should they be mindful of the fact that also there'll be money moving back into TDs because you get more in the banks? Or conversely, does it mean these yields will increase, or are you buying them more for growth?
Okay, so dividends are obviously a pass-through of earnings. So if earnings are going up, it's a positive for dividends. The issue with the banks is payout ratios are high at the moment, so you probably don't have a lot of room for dividends to grow in the banks. So dividends in the banks will probably stay stable. If you look a little bit further afield and think of stocks like Sydney Airport, so Sydney infrastructure stocks. So if you're putting your money in a term deposit and getting 2%, then all of a sudden in 12 months' time you can put it in the bank and get 3.5%. Those term deposits become more appealing. So then, naturally, you're going to get some money moving out of those, defensive sort of yield plays, and that's what we've seen. Sydney Airports, for instance, if you price it on 4.5% yield, which it traditionally is priced upon, then you get given the earnings growth in Sydney Airports and the dividend growth that we're seeing over the next 12 months, then you could justify $7.50 price for Sydney Airports. If you price it on a 5.5% yield, when you get higher yield, lower price, that's how you get the high yield, then you're around that $6.40 mark. So, I would argue that if you can get higher rates in a term deposit, which is risk-free, then you need to get higher rates on stocks through dividends, on bonds, etc., because you're taking more risk. So that's the major overarching theme that we're going to see in 2017. So it's going to be a year where we need to be more selective.
Awesome. And just one last thing on interest rates. Interest rates here in Australia, there's a lot of talk that they've bottomed. There are some other people saying there's going to be more cuts into 2017. We're in the camp of interest rates have based, and we may see an uptick in late 2017. Now, just want to quickly get your view on that. Where do we think rates will go? And, you talked about the US bond rate already spiking. The bond rate here, has it not already spiked as well?
Yeah, it has. The interest rates are going up here, or in the bond market they are. So yields in the bond market are going up. We don't think there'll be a cut going forward. The anomaly to that will be if unemployment starts to tick higher, but I don't think that's going to happen. So firmly, you look at what major banks are doing, they're increasing their fixed rate mortgages. That tells you that they're positioning for higher interest rates. So you just got to be conscious of it in your portfolio and the stocks that you hold. So, we've got QBE in the portfolio. A 1% increase in rates globally. So QBE has, a number of different components to their business, but they invest a lot in the bond market. A 1% rise in bonds globally adds about 25% to earnings. That's about $200 million after tax. Like, that's a massive uplift for a company like that. You overlay that with a lower Aussie dollar, US interest rates go higher, that should put pressure on the Australian dollar. Then you get, a double, that's supportive of earnings as well. So there's stocks out there that will benefit.
Awesome. Now, just quickly, before we kick on to the next area, you mentioned QBE. We're lucky enough to hold QBE from around about that sort of $10.50 mark. Currently in the 12s.
I thought it was lower, but anyway.
Yeah, well, so I think it was slightly lower. I'll get the exact price. But mid-10s, mid to low 10s. Now, your thoughts on that stock moving forward, and would you still classify that as a buy, or would you say the risk reward's gone?
Risk reward isn't there. We got it near in the high nines, I think, from memory. You're underselling us there, Nick. No. Thanks, mate.
Must have missed that one.
Yeah, the risk reward is lower now. So you buy pullbacks in QBE. We saw it 4 or 5 days ago. QBE dropped 50 cents. Those who didn't buy, that's an opportunity to go in and buy. So what we're seeing in the market now is that we're seeing major trend changes. So US bond yields rally, but they'll rally too far and then they'll come back a little bit. But the overall trend is higher interest rates. So if the overall trend in QBE is up, you probably don't buy when it's making new highs. You buy it on the retracement. When the short term, something's overbought or oversold in the short term. So you buy the dips on QBE.
Is that like when you're looking at a stock and you say that the trend's up for the next 6 to 12 months? Is that the way that you generally function? Looking at a stock, just QBE as an example, buying it under 10. Watching it rise all the way to 1260, 1270. What a lot of investors will do out there, a lot of people I speak to on the phones, they'll generally chase it on an up day. The market will be up 50 points, they'll buy QBE on a 4% up day. But are you sitting there and you're buying that sort of, those dips back? Is that when the technicals come in? When you're analysing a stock?
Yeah, definitely. So I mean, we talk a lot about macro scenarios in our morning reports, and that's, you've got to get the macro trends right. So the bigger picture macro trends, and then how stocks fit into those bigger picture macro trends. And QBE, you can say it's rallied 20%. Should we take profits? But it's been the last 3 or 4 years where everything has been going against QBE. So it's a massively leveraged business, and interest rates go higher, the Aussie dollar goes lower, commercial insurance premiums, which have been under pressure for a long time, start to bottom out. Then there's a lot of leverage in that business. I don't just want to focus on QBE because we've got Suncorp benefits from these themes as well. As I said before, the banks benefit from these themes. And you look at our portfolio. We've got Westfield and Transurban, and you kind of ask yourself, why have we got those in the portfolio? Because if we think interest rates are going high, bond yields are going higher, you wouldn't have those necessarily in the portfolio. But as I just made mention of, trends overshoot to both sides of the ledger, and we think in the short term that bond yields have rallied strongly. Bond yields have gone up in a really quick fashion, and there's an opportunity in Transurban and Westfield, but we won't be sticking around there. We'll be taking profits on those very shortly.
Okay, so the next topic I want to talk about is the resource space. Now, resources have had a phenomenal year. We came out in our outlook piece at the start of the year and said this is one time to probably hold resource stocks as a medium-term investment. I guess if you took that advice and just held them for the whole year, you would have done phenomenally well. Now, we did pick BHP at 14, in the mid-14s. We picked the likes of Fortescue at $1.50. I guess for investors out there that may now be holding some resource stocks as they accumulated in the back half of the year, or even bought them at the start, or conversely, investors that still hold them from multiple years ago when BHP was in the 40s. What are we doing here? Should we buy resources up around these levels? or I guess should we be waiting?
We bought some resource stocks at good levels and we didn't hold them long enough. That was our issue in 2016. That said, we are, you sit back and go, what are resources doing now? There's a lot of talk, media, analysts, etc., around the upgrade that's coming for resource stocks. So, we've seen a lot of the bulge bracket brokers upgrade their commodity price forecasts, and that obviously drops down into where they see these commodity producers going. I'd be on the other side of the spectrum, so we don't have any resources in the portfolio at the moment. I'd be on the sell side of resources in the short term. I look at a couple of things. So if a theme is well known, if everyone's expecting resources to be upgraded, and they are, that's already priced into the market. So I speak to a lot of people. I speak to fund managers. I speak to institutional retail investors, other commentators, etc. And that is the consensus call, that resources will be upgraded. So if you plug in spot commodity prices for BHP, you get a net present value of $38. So
is that with the current
spot
oil price where it is, and the sort of 80
oil price,
gold
80 price? Yeah, exactly right. So there's if commodity prices stay firm, then resources will stay firm. I just doubt commodity prices will stay firm. Iron ore has rallied a lot further than what the fundamentals would suggest it should. So I'm not standing in the front of strong momentum in the iron ore price, but I think it goes lower in the. I think it's had its run up above 80. I think it goes lower from here.
And I guess at Market Matters we've really earned our crust. Being active in this space. Price takers at the end of the day, you don't want to hold them for the longer term a lot of the time because they can be on a whim and a prayer when commodity prices get smoked.
I had. Like 12 months ago, we had BHP CEO sitting in our boardroom and followed by the Rio CEO as well, talking about the outlook for iron ore prices when they were in the 30s, and they were positioning for iron ore prices to go lower. So they haven't foreseen this $80 massive rally in iron ore prices. So. Coal prices, ask Whitehaven Coal, they didn't foreshadow coal tripling in the next 12 months, in the last 12 months. So, coal now, to me, is one of those commodities that are flagging lower prices in the broader commodity complex. So, both sorts, thermal coal, coking coal has topped out in the spot market. They're down, 20 and 15%. In the last 5 weeks or so. So that to me is an indication that money's coming out of that area.
Okay. I guess let's stick with the resources theme here to a degree and talk about gold. Now, our view on gold at the start of the year was we thought it would rally $200, $300. It actually has rallied initially a good couple of $100. I'm not sure of the exact amounts, we'll clarify. Now, in the past, we've done very well off Regis, and going back even further, we've done well off Newcrest back when it was $8 or $9, a couple of years ago. Now, we missed that last little uptick in gold. Now, gold stocks from those levels have corrected, almost 40%. Some have corrected 40%. Now, James, would you say this decline in gold is a buying opportunity, given where the spot price is now and where the stocks are? Or are you erring on the side of caution and, I guess avoiding this area for now?
Yeah, not yet. So it's not a buy yet. So to give you some context about where gold had gone, it peaked out back end of 2011 at 1900 an ounce or thereabouts. Is now trading around 1130 an ounce. So you look at these longer term trends in gold. Gold is very much exposed to what the US dollar is doing. The US dollar has been rallying, rightly so. US interest rates are going high. The US economy seems to be improving. Expectations that US interest rates will go higher. So, if the US dollar continues to go higher, then gold will be, continue to be under pressure. So, I think you'll get some short-term bounces in gold. We've seen it this week. Gold bounced, $5 the other night, and there was a bit of buying in the gold plays. But I don't see it as a medium-term trend just yet. So the US dollar's got to top out for us to get interested in gold. So if it's 1130 or around that at the moment, the previous low is around 1,050 US an ounce. So I'd be looking for another $100 on the downside for gold before we get interested.
Okay. Also, as well, the way that Market Matters has played gold in the past is through gold stocks. of differing sizes. That way, based on the spot price, you really get that leveraged impact. Have had a few questions on the phones, and a lot of our subscribers have been asking, which gold stocks would we be looking at into a correction? Have you got a couple on your radar that you do watch relatively closely at this point in time?
Newcrest, Regis and Evolution are the three main gold stocks. Newcrest, obviously, it's a big play, so you get a lot of that money that is playing gold simply being exposed to Newcrest, largest, most liquid stock in the gold space on the ASX. But it's a bit of a turnaround story. So they've got their Lihir operation is turning around. Parts of their other business that have struggled in the last couple of years are starting to turn around. So I like Newcrest, but I just don't think it can't rally when gold's declining. So get your call on the gold price right, and then go and buy. Newcrest. I think there's upside in Newcrest operationally, and from the gold price, mid caps, Evolution and Regis. I mean, we had a good trade in Regis this year, made 28%, I think, from memory. So there's opportunities in gold, but I was asked this question yesterday: do you have a portion of gold in your portfolio, like 5% or 10% in gold in your portfolio? I can't see it. Like I simply can't see it. Why would you? Particularly in a rising interest rate environment, gold's there to be, traded in my view. So you've got to be active around it. So that's the way we approach it.
And we do get a lot of people that have, the explorers in their portfolio, little gold explorers. Now a lot of these stocks tend to be on a bit of a whim and a prayer, to quote what I said before. Now, do you ever look at that space, or is it just not worth looking at in your view?
Yeah, it's all to do. We don't look at it much for market matters because of the liquidity in that space. So you've got to get the gold price going high. You've got to have a good understanding of the company, what they're doing, and trust management. Like that's the biggest issue in that small space, is the ability to trust management. So no, it's not going to be a case where market matters focuses on that area. We're more in the liquid mid cap, large cap space. So not overly.
Awesome. Now, just to finish, just wanted to talk about, we've had an incredible run over the last few years in the US market. The Australian market has done okay, but been quite range bound. We've also had, an incredible, bull run in bonds over the last multiple years. Just wanted to get your view on do you think the bull market in stocks will end in 2017, and do you also think the bull market in bonds will end in 2017?
So 2009 it started. 2000 we've had we're back into 2016. So we're 7 years into it. Typically, you start to see markets wobble around that. I think the catalyst is going to be around interest rates going higher. The market's been bid up on low interest rates. It's been bid. There is an economic recovery happening, but don't underestimate how the massive impact on interest rates. So if I think about what's happened in the last 12 months, the US market, the Dow's up 14%, S&P's up around 10%, we're up 5.6%. That's a little bit underwhelming on our side, but you can understand why. Resources and banks dominated the market. So if I look at the S&P 500 from a technical standpoint, I then move on to the Russell 3000, which is a more of a broader index over in the US. So 5 phases of a bull market, and we're in the 5th phase. So the Russell, if we're putting some numbers around it, the Russell based out around 400. We then rallied in the first wave up to 800. We pulled back about 200 points. We've then rallied from 600 to about 1275. So, call that 675 points. We then pull back another 200. Wave 5 is typically the same size as wave 1. So you're looking for about 400 points on the upside from that 1,050 level on the Russell. That might confuse a lot of people out there, but you distill that down and say we're looking for 7% or thereabouts upside in the US market from current levels before a major top comes in, and then we'll be getting pretty cautious here, I've got to say, Nick.
Okay, and you've talked about a blow-off top a lot in the reports. We commonly talk about a blow-off top. Now, for investors out there just wanting to know what you mean by that. What do you mean by a blow-off top? Is that FOMO driving markets and all cash coming off the sidelines? What is the most technical definition you can give for that?
I've had so many conversations with investors that are now after not being comfortable with the market and now starting to be comfortable with the market and putting more money in. So it's fear of missing out. You see the market go higher, you want to be involved in it, so more money comes on the sidelines, pushes valuations to extreme levels. So if you get this, fund managers can't sit there and watch the market go higher and not participate. They get paid on performance. Cash levels are really high. We've spoken about that in the reports. US fund managers are sitting on a lot of cash. So that money needs to go into the market. So you get this, you get a lot of money going into the market at a specific time. Stocks obviously get stretched, the market goes higher. And then all of a sudden you get interest rate hikes. You get some catalyst to see some of that money come out of the market. So it's sort of nervous money. It's money going in there that's happy when the market's going up, but it'll come out pretty quickly when the market starts to go down. And there'll be some catalyst that will make the market go down. My thinking is it's going to be interest rates, but it might be something else. But you've just got to be really cautious and cognizant of that fact that we are at the mature stages of a bull market. We are seeing signs of people throwing money in. Stocks got elevated, valuations were high. The US market valuation's reasonably high. Our market valuation's reasonably high, and our market valuation will look even higher if commodity prices pull back, because the earnings growth in the Aussie market has only been driven by the uptick in commodity prices. That's all. So our market will look very expensive if that trend changes.
Okay. Just one last thing I want to finish on. We've called 5,700 as our year-end target for the ASX. Looking like we're getting extremely close. We've almost taken out the high for the year. We got very close to that 5,611 yesterday. Now, are we still? I know it's only a week or so away, but are we still anticipating 5.7, or could we even push higher?
Yeah, I have a crack at 5.7. It's pretty hard. It's pretty hard to put a number on it, but we'll stay with 5.7. You see what happens in the market. There's low volume, so there's 30% below. The average is going through the market, so you tend to just grind higher. So it's not that there's massive buying out there. It's simply that there's no selling. So you don't see fund managers make any major changes to their portfolios over this time. So 5.7 year end. We'll stick with it.
Okay, awesome. Thanks a lot for joining us, James. Merry Christmas. Now, all the investors watching out there, thanks for joining us as well. Any further questions about anything we've talked about in this webcast, feel free to reply to this email, or conversely, you can always get in touch by calling the 1300 number. That was 1300 301 868. That was 1300 301 868. Thanks again. Have a lovely Christmas, everyone.